Welcome to the Seattle Angel Conference workshop series. Today we have Hall Martin from 10 Capital, who's going to talk a little bit with us around this question of deal terms and some of the key aspects of a deal that we need to pay attention to. In the Seattle Angel Conference, we gather 40 angels together. The investment per person is $5,000 a piece with a $1,000 fee on the side this round. And then that process produces one lead investor that organizes the process for everyone. And then they have to negotiate with the finalist companies whether that deal is a reasonable deal or not. And that process of finding a reasonable deal means that you have to look at sort of the global structure as well as the nitty-gritty details about what is this actual piece of paper I'm signing, which changes how things essentially work. And so I firmly believe that the kind of company you can invest in is fundamentally determined by the kind of terms you want. And Hall is going to jump into the details of this, and he uses a very interesting model that's worth paying attention to. Hall, could you tell us a little bit more about yourself and about 10 Capital?
Yeah, thanks, John. Thanks for having me, and looking forward to talking with you guys tonight. I'm based in Austin, Texas, and I run a company called 10 Capital. I started 11 years ago under the name Texas Entrepreneurs Network, and we connect startups and investors for funding. We work with VCs, angels, and family offices across the U.S. And so tonight we're talking about deal structures and some of the key terms that come up there. It won't be a comprehensive list, but it'll be the ones that come up the most often that you should know a little bit about, and we can go forward from there. Looking forward to chatting with you guys on these topics tonight. Should we go and jump into the slides, or what would you do next?
Yes, please. No, maybe you would like to know a little bit about Ken Allgood, who just came in. Ken, you want to introduce yourself? Apparently you're on mute. All right, we'll skip Ken and we'll go, Hall, go right into the talk and put up the slides.
Okay, let me go ahead and share my screen and put up the slides. Let me know if you guys can see the 10 Capital logo there. And if so, we'll go ahead and start to move into the presentation itself.
We can see your slides.
Okay, great, thanks. So let's see. Well, there we go. So if you look at the list of terms in a term sheet that you could use, there's over 125 of them. And so the first thing you want to do before you dive into those terms is to look at the right deal structure and then identify the key terms for the one you're using. The first deal I ever did, we actually went through all 125 terms and then later figured out there's only about 5 that really mattered. And so don't make the mistake I did and look at everything, focus in on the ones that are really important and realize that these other terms may be useful for you in the future, but they're probably not something you have to spend time. So don't get lost in all the minutia. And so if we want to look at the term sheet structures, the vast majority of startups you'll see coming around will have a safe note or a convertible note. And if someone has priced around, they'll have an equity term sheet. But realize those are not necessarily the best term sheets to use. It's just whatever they have picked up and are running with because everyone else is running with them. And so the first thing you want to look at is are we using the right term sheet for what the company is going to do? And we'll talk about that here in a moment. But if we look over here under equity, basically, it gives you ownership in the company determined by the valuation that you've agreed upon between the investor and the startup. And the key term you want to look at in that term sheet is the pre-money valuation. This is when there's a price already set for that term sheet. And this is the most common one used in startups. And the thing you want to ask yourself is, what's the exit here? And that's a good question to ask the startup when you talk to them that is proposing a term sheet to you, is how will the investor get paid back? And then see what the answer is to that question. Most of the time people have a general idea, but they don't have a very specific one. But if the answer is we're going to sell the business to another company or go public for a very large return, well, equity is a good structure for that. Next one down is what is called a safe note, and it stands for simple agreement for future equity. And you'll see these a lot as well. And a safe note basically is the right to buy stock at a later date at a specific price. And the key term you want to look for there is a valuation cap. What is the most valuation that thing can be valued at when it converts for your actual exercise? And people use safe notes because they're very simple. They're very low cost. There's typically no attorney involved. And so you can just download this off the web, fill it out, and off you are running with it. In the very early stage companies, there's usually not money to pay for the more expensive equity term sheets. And that's one reason why people use safe notes as well. Next one down is convertible note. This is the predecessor to safe notes. It's what we used for many years. And basically, a convertible note is a debt instrument that converts to equity based on the note maturing or a follow-on equity fundraise. It's not meant to be a debt instrument. If you want a debt instrument, you just go use a promissory note. A convertible note is different because it's meant to convert to equity at some point in the future. And again, the key term you want to look at in that is the valuation cap. There are other terms like interest rate and discount rates, but what you'll find is those have very little impact on your return and is really not a key issue. The next one is called KISS, and it says keep it simple security, and it's an equity instrument that gives the investor the right to buy shares in a future round. Again, the pre-money valuation, and we'll talk about that in a moment, is one of the key elements to look at in the KISS term sheet. And these are very common ones. Now we start to get into things that are not so common. And for example, there's what's called SEAL, which stands for Shared Earnings Agreement, and it pays the investor back at the rate of founder earnings. So as a founder takes a salary, you're paid out on that as a rate rather than on equity or debt or some other factor. And the rate of income is the key factor to look at in that. How much do you get paid per download of salary? Next one is called revenue-based funding, or shortened to RBF. And what it says is that it's going to pay the investor back at the rate of revenue. You put money in, and every time they earn some revenue, you get a piece of that coming back for yourself. And you look at the payback rate. Are you taking 2, 3, 4% of top line revenue? How much are you taking back? And how much of your investment are you going to get paid back? Are you going to get paid back 2x, 2.5x, 3x? And this is usually over a several year period. But once you get paid back, you're out of the picture. You're no longer involved in that company, unlike equity where you're involved until they sell the business. And then finally, there's what's called 3X and 3. And basically, it's a convertible note with the redemption right to the investor at year 3 for 3X your investment. So 100K in is potentially 300K out 3 years later, where you have a redemption right to go and convert that into debt, or forgo that and go on the cap table as an equity owner. And that's really meant to be an out in case you come into a business that doesn't go all the way up to an equity exit. I found in many years of experience is the biggest thing you want to watch out for is not the deal that goes under and declares bankruptcy, but rather the deal that goes sideways and turns into a lifestyle business. My estimation, about 50% of them turn into lifestyle businesses. And if you're holding equity, that can be a problem because there's no way you're going to get your payback out of it. And when you find that situation, or in advance of that situation, if you sign a 3X and 3, you have a way of getting out of the deal in case it's not going to be a big equity exit for yourself. So let me go back and let's stop here for a moment and ask any initial questions, and then we'll maybe dive into these in a little bit more detail so we can talk about this. Anybody have any initial questions they'd like to pose?
Hey, Hal, for the 3x3 or any of these other ones, can an original investment be converted to that? For example, we start off with, let's say, SAFE, and then later on in the growth of the business, can we switch that to 3x3 or any of the others?
Typically not. When you sign up with an equity or SAFE or convertible note, the terms are set, and it's going to turn into equity at some point along the way. With seal, you really have to start with the seal and go forward with it. And with seal, you can turn, if you decide, well, I think there's going to be a bigger equity exit here than just getting paid back on income, I can convert mine into an equity position. RBF, there is no equity conversion, and 3X and 3 is unique in that it gives you a choice of going debt or equity 3 years down the road. Once you sign an equity agreement, my experience is it's very hard to negotiate redemption rights later. The entrepreneur on one side and the investor on the other side are typically very far apart as to the valuation, and so it's very hard to close it. And one reason why I use the 3X and 3 is before we ever go into the deal, we're determining what the debt version of it might be, or the redemption might be, or what the equity might be. And it's defined up front, so you know which way you can go. And in the 3X and 3, it's investor's sole discretion. Every investor gets to make their own choice is how that works. And for some, in my experience is about half the entrepreneurs who sign that really hope you take your equity and convert it to debt and go out because they want the equity back. They don't want the dilution. The other half really hope you actually convert to equity and not take the debt because they don't have to pay you back at year 3, 4, or 5. Fundamentally, at 3X and 3, if you get to a place where you want your 3X redemption right, it converts into a revenue share, and you just get paid back out of revenue over a period of time, usually about 2 years is what we see. So the answer is it can be very hard to move from one structure to the next once you sign up with these deals. Any other questions?
Hi.
So,
yeah, go ahead.
Yeah, one quick question. So are you going to talk anything about which term sheet structure makes sense for what type of business model?
Yes. Let's move on to the next page here. So which one to use? So one reason that you see a lot of SAFE and convertible notes and KISS notes is that in the very early stage of a company, it can be very hard to set the valuation. You just don't have enough information. There's not enough revenue. There's not enough product there to really figure out what the right number is. And so a SAFE note, convertible note, and KISS note are often used at the early stage to avoid setting valuation. And that may be a good thing to do in the very early stage because it's just not possible to do. And so I always ask these two questions to determine which of these term sheets should I use. Number one, what is your valuation? Just to figure out, can we agree upon a valuation? If the investor and startup can agree upon it, well then these tools like an equity term sheet can be used in that case. The other question you want to ask is, what is your exit? And that's really the critical factor in most of these, is how does the investor get paid back? And I'm amazed at how many people hand me an equity term sheet, and then when I ask them, how am I going to get paid back? They look at me like, what do you mean get paid back? And the answer is we don't plan to sell the business. Oftentimes these businesses are family businesses and they're going to stay in the family, and we're not going to sell them. And so the answer is we don't use equity for those deals. We go look at revenue-based funding, seal funding, or even 3X and 3 funding, because those are ways to get paid back without having to go into selling the business itself. So start with the exit and work your way back. If you can agree upon valuation, well, then you can go ahead and sign up an equity term sheet. If valuation can be hard to figure out, well, then you want to go do a SAFE note, convertible note, or KISS note on those things, because those don't set the valuation up front. So start with these two questions, and then you can figure out which is the right term sheet to use for your deal. The reality is with most SAFE and convertible notes is that the startup doesn't have funds to pay for an attorney, and most investors are not going to spend the time to set the valuation. The key there is you have to really analyze the deal, look at comparable companies. You have to look at what the plan is very carefully. And many investors who are putting in 25, 50K are really not going to spend the time to go figure that out. That's really for a later stage investor to figure out. And so they just sign the safer convertible note because now they can be in the deal and they don't have to worry about the valuation. We'll kick the can down the road a year or two to figure out what the next one is. So those are the two things we look for to figure out which one to use and in which case. Any questions about that?
Yeah, I have one question.
Yes.
This actually goes back to the earlier slide. Is there a structure you can set up for a non-accredited investor to participate in a funding round? So one thing I read a long time ago was you could structure it as maybe the investor loans money to the fund with a zero coupon bond with the principal attached to the gross in the principal in the fund. And then the fund makes the investment in the company for whatever they do. And then it's not an equity investment, it's just a debt investment. And then maybe a non-accredited investor could do that.
Well, that sounds like a very interesting structure. I'm not familiar. I'll need to look into that more. One thing you can realize is that on an equity investment, you can sign a specific form that lets you take on 35 non-accredited investors. It's this form that basically allows family and friends to be in the deal. And so there is an option to bring in a certain number of non-accredited investors. And if it's a small number, we'll then just do an equity investment and then sign the form that lets you bring the family and friends or just one or two people. If, on the other hand, you want to raise more than from more people than just a handful, 35, I think is the limit, you really want to start looking at Title III crowdfunding. And Title III lets anybody invest, and you go work with a crowdfunding portal to put your deal up there, and then a lot of non-accredited people can come into the deal, and angel investors can put in as much as they want. There's no limit to them. But the idea is you can actually find other structures out there outside of this angel world that will let you bring in non-accredited investors, and Title III crowdfunding and Reg A funding are the two mechanisms we see people using for that. Title III lets you raise up to $5 million. Reg A lets you raise up to $75 million. And the SEC looks at that as basically the company going public. But if you think you can benefit from a large number of non-accredited investors coming into your deal, they buy your product, they build your brand, they raise awareness. There's certain advantages for consumer-facing deals where people do this as well. That's one way to do it. Otherwise, it can be hard.
I was going to do the friends and family with a startup I was looking at. And then I was going through the due diligence with John Seacrest Group. And then I parted ways because of the due diligence. So that's no longer an option. And then I kind of got swept up in this SAC conference. And I'm trying to figure out how I could join that as a non-accredited investor. And that's a little bit different structure.
Right. Okay.
So talk a little bit about the consequences of non-accredited investors on the cap table to the company.
Okay.
Hall.
Oh, well, yeah, there is a limitation, when you have non-accredited investors on the cap table and there's future rounds of funding, they're not going to be able to continue to go with the deal. At some point, the follow-on investors are not going to want to see non-accredited investors in the deal, and it can become problematic. So if there's going to be follow-on rounds, that can be a bit of an issue. If we're just raising money from family and friends and it's just going to stay here for this stage, then it is okay to do that. But for the longer haul, if you're really going to be raising from VCs or other funds, that's going to be a very problematic deal. There's also a limit as to the number of investors you can put on there as well. So you can't go too far down that path with non-accredited investors. What else were you thinking about, John?
There's two other pieces that happen. One is you have reporting requirements. And when you add unaccredited people to the table, then the company needs to be reporting about the company more at the public level rather than the angel level. So there's additional costs to running the deal then. And there's accounting requirements where you end up implementing some level of reviewed accounting, and so the price for your CPA goes up. And so both of those are supposed to be happening when you do unaccredited people on an early stage deal.
That's a good point.
So John, and where does Wefunder kind of fit in to help that gap or not help that gap?
So Wefunder is using the crowdfunding, federal crowdfunding law, which is now labeled Reg CF. And so they skip around it by going through a different exemption. So the Reg D 506B, which is where 92% of angel investing happens, is where Hall is talking about the 35 accredited investors. It's a private solicitation pathway. Reg CF is a public solicitation pathway, requires portals and other little bits in it, but it allows for you to raise $5 million from the general public, but it limits the percentage of the net worth of the person who's investing, which is not true for like Reg A, or sorry, not true for Reg D 506B, where, you know, if you're an angel investor and you want to invest 90% of your net worth, there's no constraint.
But would, if one used Wefunder, would there be the follow-on problems that Hal was mentioning?
Yes, absolutely. The same level of structural issue of, do the follow-on fund people believe that having that group of people on the cap table is win? However, they do create an SPV at Wefunder, and they do have only a single entity on the cap table. And so the decision making is appropriately simplified. So that's useful.
Yeah, my experience with the Wefunders is that the average investment on Title III crowdfunding portals like that, and the top three are Wefunders, Start Engine, and Republic. There's 45 others out there as well. The problem is many of the valuations are set at such a level that they don't really fit the angel or venture capital world. So when they go to raise funding, I've seen people with $100,000 are putting a valuation of $20 million on their valuation. And if you're staying in the Title III world, that seems to be okay. Everybody's putting in $500. They're not worried about it. But once you step out of that world and you go to angels and venture capital, typically you're now misaligned with what VCs and angels consider to be the proper valuation. So you want to think hard about follow-on funding from the point of view is, will my valuation play to the non-Title III world later, is the big issue.
And that's one of the reasons that the Wefunder folks have started recruiting what they're calling lead investors, where they get accredited people to come in and put a semi-bigger check, you know, 25K check or 50K check in, and then do the due diligence. And to do that negotiation around valuation and the deal terms a little bit, so that the follow-on people in the Reg CF component have something that's a little more bounded, that makes it more appealing to the angels and then the venture capitalists beyond that.
Cool.
Are there other questions from folks?
So I said I'd dive a little bit more into these key terms. When I say pre-money valuation, should I tell you more about that? The issue is when you are investing in a startup from an investor's point of view, you know, they usually you need to figure out what is the valuation of the business before the money goes in. And the way this works is pre-money valuation. Let's say the business is worth, we agree it's worth $4 million plus investment. Say we're putting in $1 million equals post-money. So pre plus investment equals post-money. So 4 plus 1 equal 5. The ownership of the investor is the investment divided by post-money. But when you talk to people, they will always be quoting you in pre-money valuation. What is my business worth before you put your money in? You put the money in, now your ownership. And so you can see very quickly that the entrepreneur is motivated to push the valuation, pre-money valuation higher, and the investor is trying to push the valuation lower. And what you'll find in these things is that while there are many formulas out there for what the valuation may be, there are many comps out there, in the end, it's not a formula, it's a negotiation. No matter what number the entrepreneur puts out there, the investor is going to ask, how did you arrive at that, and vice versa. So realize these things are not just simple equations, they're really negotiations. And it comes down to what are the values in the business today. I find one of the biggest disconnects is entrepreneurs think one day my business will be worth $100 million, therefore I get $100 million today. Well, no, today's valuation is what's in the business today. Tomorrow's valuation is what is in the business tomorrow. And so we have to go back to what is there today. And so valuation is a very key factor because it's one of the biggest determinants of the return an investor gets and how much the startup has to give up for the money that they're taking in. These things like valuation cap, what those are basically saying is we don't know what the valuation is going to be based on follow-on funding or what have you, or if the note matures and there is no follow-on funding in that time frame, what number will we use to convert to equity? And the valuation cap just says, well, it will never be worth more than that valuation. So if I put a $5 million valuation cap on my convertible note, 3 years later, it matures, no other fundings come in, my money will convert at the $5 million valuation cap. So that's what those terms are looking to do there. And then with SEAL, rate of income is for how much money someone takes in the way of salary or profit, what percent of that goes to the investors is rate of income. And then with the revenue-based funding, the payback rate, as we said, is basically what percent of top-line revenue are you going to pay out every month based to the investors, and how long are we going to pay out until we stop? And 2x, 3x, these are the numbers you often see, 1.5x in some cases. So if I put in 100K, it's 1.5x. We're going to keep paying the investor back till we get to 150K. 100,000 times 1.5x. So those are some of the key terms to look at when you are dealing with these sheets. Like I say, there's 125 terms and we can look at some more of them right now. But when you look at these term sheets, realize the ones that make the biggest impact are usually around valuation. Are there any questions on valuation at this point?
Well, the classic question is, I have two guys and a dog and a software prototype. What's the valuation of the company when there's no revenue?
Well, my answer to that is I always use the rule of 4. I don't know if anybody's heard of that before or not, but I say that for a startup that comes in and they've got some code and a little bit of a customer interaction, maybe some IP and so forth, the rule of 4 says you get $1 million of pre-money valuation for each of 4 things: the sales, the team, the product, and the intellectual property. So if you have the sales full blown, everything's going well, customers signing up and so forth, give yourself $100,000. If you don't have the full blown thing, but you maybe have a few beta sales and a few project sales here and there, give yourselves some percent less than that. Maybe we give ourselves 500K for the sales. Same thing with the team. If we have the full C-level team in place, everybody's working well, $1 million. Maybe only have 2 of the 4 people, so I'm going to give myself $500,000 instead. So it's a bit of an estimation, but you can see what we're trying to do is value the business for what is in the business today. And we're trying to go through and see what is there with respect to the sales, the team, and then the product. If the product is fully featured, robust, shipping and working, give ourselves $1 million. If the product is maybe in beta mode, give ourselves maybe 300K. And then intellectual property. If I've got my patents filed and awarded, give myself $1 million. If on the other hand, I filed 3 provisionals, well, let's give ourselves maybe another 300K for it. So you then add up all of those pieces, 500K, 500K is $1 million, 300, 300, 600. So we're coming out to be something like $1.1 million pre-money valuation. As I can move those things up, I can actually move my valuation up, and it never comes out above $4 million. you'll see many deals structured well above that in today's market. And what I do is say, well, up to $4 million is what the company can be worth. And what goes beyond that, maybe another $1, $2, $3 million of valuation, that's speculation. We're just speculating that that is going to be worth it, but that's not in the business today. And you should know that as an investor, you're investing in value at some point and you're speculating at some other point. But that gives us a way to sit down and talk about what is in the business here today that we can value. Discounted cash flows are usually not sufficient. Book values are not sufficient. Asset values are not sufficient because they don't really capture what value is in the early stage company. So let me stop there and see what you guys think about that.
Would you put discounted cash flow in your speculation bucket?
Well, the issue is most companies don't have enough cash flow to calculate a meaningful number around, valuation. There's just not enough revenue coming in to actually project it out. And in the future it will be more, but you just don't know how much more. And typically when you talk to people in the finance world about discounted cash flows, it's for cash that's flowing today. It's not for, there's some evidence that there's a flow there, and then we're just estimating out how far that will go. But when there's little or no cash flow for these deals, then it's just very hard to figure out what number to put in for that. And so that's why I don't really use cash flows and try to go back to what are the values for a successful business. Well, that's usually a very strong team. You have some customer traction. You have some product that you've already built that you can build and people will buy it at some level. And then intellectual property is the one that usually is a factor that will come into this down the way at some level. So we're just trying to shift it away from being a quantitative estimate to be more of a qualitative estimate based on what values you can find in the deal at this stage, which is very early stage.
Yeah, I guess I'm asking then, how do you factor in the size of the market to the value of the company? Is there anything?
I would say that, a large market is really more of a table stake structure at this point. You have to have a very large market or it's really not a venture level deal or will not succeed as a venture level deal. So, and whether it's $1 billion or $5 billion, it probably isn't going to make much difference at this stage. Down the road it will, but at this stage that's probably not going to be the key factor. So I look at there's certain things that you really need to have that just make for a startup, but it's not going to be a separate thing.
Okay, that makes sense. That the market size is what really qualifies you to be of interest to the VC world. If you don't have a certain size market, they're just not going to be interested anyway.
That's right. You're just not going to meet the structures right up front, and so yeah,
that makes sense. Thank you.
Paul, do you recommend getting some officials to help out with valuation, given that obviously one take on one's own company is maybe grossly disproportional to what the investors are. So to get some type of a financial objective player to come and evaluate the company kind of as is.
It usually brings a little bit more information to the table, but at the same time, I think you're still left with a problem. We have to negotiate this and come to agree upon it. And if the one doing the valuation is helping do the negotiation, I think there's value add there. But in most cases, what I find, there's a market rate out there. If I take a deal around and I show it to everybody and I'm saying this is worth $5 million and I get, one head nodding and 20 saying, no, I'm not going to do it. The market is telling me what I need to know, which is this is not acceptable. If I go around with, say, a $4 million and I get 5 heads nodding and more heads nodding and fewer heads saying no, then I start to realize, okay, I'm starting to get into a place where the market is agreeing with me. And as startups, they go out and they talk to many investors and they put the number on the table. They can start to figure out where the investors really think that is. In some cases, you need to go get a professional to help identify all the values and put a number on it. But I find that that's usually not the final answer. That's just one more piece of the puzzle for us to negotiate. John, what's your experience with people doing formal valuations?
My experience is that in the early pre-seed and seed levels that they're worse than useless. They bring someone who doesn't understand startups to the table to do some kind of hand wavy thing. So they hand wavy away, and now we got a random number.
Right. My advice to startups is to, think hard about what's in the business today and articulate the values that are in the business. What can the team really do? Why is that a great thing? How far along is the product? What is really developed? I see many presentations where they show me a piece of software, but I have no idea, did we do 2 out of 50 modules, or have we done 14 out of 15 modules? How close are we to the place where people will buy the product? And so instead of letting people guess at that, tell us that, identify what the values really are in the business specifically. What exactly is the value of that IP? What exactly is the value of that customer? Are they going to buy more? Are they going to help me sell more? Are they going to use the brand? What else can you tell me beside the fact that you sold 100K? Give me some more detail about the value of that revenue. Not all revenue is equal. Some revenue is more important than others for various reasons.
Absolutely.
Cool. Any other questions on the term sheets or the structures? If not, we can move to the next level.
Yeah, I do have a quick question.
Sure.
Regarding the valuation, how you feel about comparables? If I find some other company, they have similar business model at similar stage, can we use that valuation from before as a benchmark for this new company we are trying to invest?
Yes, I think comparables are very good. As you know, the valuations also go up and down based on the stock market. When the stock market's very high, exits are very high, therefore valuations tend to be high for startups. When we're in a recession, stock market's down, exits are down, therefore you're not. And comps help us kind of ride that wave a little bit to figure out what that looks like. And it gives you ballpark figures. People come to me and they say SaaS businesses are 5 to 7 times revenue out there with certain CAC LTV ratios, and that starts to give us a ballpark that we can start to negotiate into. So I believe in comps that, but they're not perfect. Sometimes you can't find a comp that's right exactly with what you're doing. In some sectors you can, other sectors you can't. You can try to look at other valuations from similar companies at the same raise level to see where they were at as well. But like I say, you'll find yourself moving from that to a negotiation sooner rather than later as well.
Thank you.
Cool.
So Julie asks if there's a way to bring a valuation down after there's already an investor or a convertible note in place before you or your syndicate tries to invest.
So if you have a convertible note, the valuation's not been set for a priced round, you can go in and try and come in with a lower valuation. If you have an equity deal, they've agreed upon 5 million and you have all the investors in there at 5 million, it can be hard to go down from there. The way we handle valuations that are what we consider to be too high is we start looking at a few of the 125 terms that are in the term sheets to mitigate that risk. And in this case, we use the liquidation preference. The reason there's 125 terms is that every term is in there to try and solve a problem for you. And one of the problems is we think the valuation is too high, and I don't think that the company's worth that. Therefore, I'm going to ask for a 1x liquidation preference. And therefore, when the company exits, I get my 1x back, and then we share the rest of the results pro rata. And so you can start to counteract a too high valuation with that term itself.
So one quick question, Hal.
Sure. Yeah.
So around that, in the case of a notable founder with a very good exit, same market, usually you can see them commanding pre-seed rounds in the $15+ million sometimes. Is that something that you personally would avoid a company like that, or how do you approach that with respect to the Rule 4 or other things you're looking at?
Yeah, I have a hard time with that, but I do see that happen out there. I do see people coming in who have previous exits, and what I found is it's not just so much the founder. If the founder brings the original team and we're working in the same space, well, then there's something to be said for that. I think you can give more value to that because they're bringing something extraordinary to the table, a track record of success that they could repeat again fairly easily because they have not just the same founder, but the founder with the core team. Then you have something. And also they need to be working in the similar space. You do see founders working in the fintech space, and then one day they decide to go work in the healthcare space. Those are very different spaces with different dynamics. And so I'm not so sure the game plan will work both ways. But you do see that quite a bit. They command quite a bit up front from the investors. For entrepreneurs, the thing you want to ask is when you raise a round of funding is not, can I get that $15 million at this round, but can I get the increased valuation at the next round? So if I raise at a pre-seed $15 million, when I go to my seed, I need to have enough traction, revenue, team, and so forth, and usually about 18 months to do this. So can I get the next round at $20 million? And will it go up? And if the answer is no, well then I've overpriced myself at this round. And sometimes you can talk to investors and talk them into it. Sometimes the market's such that you can talk them into it. But think not just about this round, but think about the next round. Make sure that you're not setting yourself up for failure down the way, because we see that a lot. People overvalue themselves in this round. Next round, what do we do? It can be hard.
Thank you.
Sure. So we had a few slides here. Were there any questions about revenue-based funding? Has anybody here ever used revenue-based funding?
The person that's most engaged in revenue-based funding is Looney Libs at Pledge, and he does revenue redemption, which is an equity play rather than revenue loans like Lighter Capital does. I've been involved in one African loan, but it was a straight loan, not a revenue loan. But he's got something like 63 revenue redemption loans in play. And we just added a revenue redemption clause to the Seattle Angel Conference process.
Great. One thing you'll find about revenue-based funding is that when most people come in, they think, well, what I really need is legal control over this. I'll write everything in the term sheet. But what I've experienced when I watch people doing revenue-based funding is that they look for operational control. They get access to the accounting system and the bank account, and they watch whatever goes back and forth on that. And having gone through different scenarios with different startups, I can tell you, you want operational control. You want to know what's going on. You want to have access to all the bank accounts and all the transactions and so forth. And if you do revenue-based funding, expect another user account coming into your systems to watch what goes on. And that's how they take money out in most cases. Same thing with...
We keep looking for backend that will manage that. So it looks like you hook up your QuickBooks and you watch QuickBooks, but there's some software that watches it over at Lighter Capital, but can't seem to find access to any of that software yet.
Yeah, it's a very specialized application. So, but as there's more and more of it going on, I think we'll see more come up in this direction. Same thing with Seal. You really want to have a system set up where it automatically pulls the money out based on a formula, based on how much goes to profit and to payroll, so to speak, and then you have it come out. One of the issues you get in with revenue-based funding and Seal is you have to define very, very clearly what is revenue or what is salary, have a very specific definition of these terms. So a lot of it has to be figured out in advance. In revenue, you have discounts, you have returns, you have other things that can impact it, and you want to define clearly what we all mean by that going in up front. And then The 3X and 3 we'll talk about a little bit here. If you have any questions about this, I came up with this because as an investor, what I found is I was investing in other people's lifestyle business. They would come in and talk about this being a rocket to the moon. 3 years later, they're coming to me saying they want to go to market rate salaries. Well, in an equity exit, the salary should be kept below market rate. Investors should not be taking out any dividends or profit share. We're trying to make this as big an exit as possible. And when they go on, and unfortunately, the startup has the opportunity to go on to what I call the payroll exit. Well, I'll just take my money out with a big salary. And when that happens, the equity exit is usually off the table at that point. And so I found it usually at year 3, I can figure out which way this is going. It's continuing to grow. We're raising more funding. Valuations going up. We're getting bigger. It's going to be great. Or it's now going sideways and it really isn't going to be big anymore. The market changed. We just didn't make it. The product wasn't as good as we thought. And so that's what lots of reasons why things go sideways in this. And so we came up with this 3X and 3, which is basically a convertible note that gives the investor sole discretion to convert. And we have a process for how you can convert into a 3X redemption right at year 3. We have a process for determining that and for getting everybody's decision on it, and then helping facilitate the revenue share agreement if they can't pay it all out. The reality I've seen with this is that people do 100 different things with it. They take half in equity, half in debt. They take they just slice and dice it in many different ways based on what their interests are and what the company's interests are. And it's an interesting model to give yourself a choice of an exit before you go onto the cap table and you go for the full ride itself. And one reason why this is important is because companies stay private so much longer. It's not unusual being a deal 10, 12, 15 years now. And if it's a winner, that's great. You just love to see it go up. But if it's not a winner, you just can't look at it anymore. So it's one way to get out of it. If anybody has any questions about that, I'm happy to answer those as well.
I think it's important for you to say that you provide services around this.
Right. So I've done these, and what I found is, relying upon the CEO to do the dispositions and so forth is really not a practical thing. They're busy running the company and so forth. So I have a facilities management process where we provide the information rights to the investors so they know what's going on exactly every month or every quarter. And then 6 months in front of the redemption right choice, we take the numbers to the investors and say, in 6 months, you'll need to make a decision, start thinking about what that is. 3 months, we go back and see what their decision is. And then 2 months in front, we tell the founders, well, this is what they want to do and how it's going to go down. And we start to document up revenue share agreements if that's the way it's going to go, or if they're all going on the cap table, we figure out how to move them over onto the cap table with the convertible note maturing at that point. So we take care of that for everybody. We handle that so they don't have to worry about that. And then it gives a little bit of a third party perspective on it. So everything's above board in that case.
If you don't mind, I'm sorry.
No, go ahead, Deborah.
If you don't mind, I got the gist of it, but would you mind doing the thumbnail high level again on this? Because I get the gist of it, but I kind of lost track of the 3 and how it works again. Would you mind just running the top level over again for this option?
Sure. So the 3X and 3 note is basically, it's a standard convertible note, but it has a redemption clause that gives the investor at year 3, 3X their money payout if they want, or you forego that and it converts to an equity agreement. So if I put in 100K at year 3, I have a choice of pulling 300K out and I'm out of the deal. I'm no longer there. Or I forego that 300K and my 100K converts to equity on the cap table at the valuation cap that we decided upon. And so the idea there is I have a choice of going debt or equity. If I'm pulling 300K out as debt, maybe they can pay me 100K and the other 200K has to come out of a revenue share agreement. We'll just take 3% of revenue until I get paid out. If I go on the cap table, they owe me nothing as far as debt, but now I'm on the capitalization table as an owner of 100K worth of their stock at that valuation cap that we discussed before. And so if the company's going well, and I find more and more, I just go on the cap table because the company's doing well. You know, they're not turning into a lifestyle business. Well, this is great. Let's hang on for the full ride, and we'll get far more than 3x out of it for sure. But at year 3, I do have one deal where they work on it maybe 10 hours a week. It's got some nice revenue on it, but they're off all doing something else, and they don't plan to come back. I think I'll just take my 3x and go be done with it at that point, and get something back to go put into the next one. The other opportunity here is I get a lot of incubators, accelerators, and family offices that want to grow their entrepreneur ecosystem. And they had the vision of coming in and investing in a deal. And then when the results came back, they invest in another deal, and they want to spread their money across as many deals as possible. And then they find that some of these deals are hanging on to the money and not going public or selling for 10 years. And so what some of them are doing is using this 3x and 3 model to negotiate. I want my original investment back. I want another portion I'm going to go put into another company, and I'm going to leave a third portion with you on this in this business. And I can then create an evergreen fund to foster my entrepreneur ecosystem by making more investments to more startups using a 3x and 3 model. So I see people using it in that mode as well. Cool.
That was perfect. Thanks.
Oh, great. Thanks. So some of the key terms we come across, if there's no more questions about the structures, we can always go back to that if we want to, is, like I say, one of the biggest terms you'll ever come across is valuation. And it's the price you pay for the equity. And it's the one that has the biggest impact on your return. And so you want to look hard at that number, even if they talk like this is set in stone. Well, it's what you think it's worth, and try to understand how we get to that valuation, and will this valuation lead to an exit? So one quick way to test a valuation, if you think about it, angel investors want 5x their money in 5 years. Some want more, some will take less. So if someone comes to you with a deal that says, okay, we're putting a $10 million valuation on it, and we have $1 million of revenue, ask yourself, in 5 years, will this company be worth 5x? So if that $10 million in 5 years is going to be worth $50 million, do I see myself, or do I see this company getting from $1 million of revenue to another revenue stream that will make it worth $50 million? So do the 5x and 5 test on it and see if it's reasonable. I've had people come with $1 million and they're worth $50 million valuation. So I put the 5x on it, it's 250. Do I think this $1 million company is going to be worth a $250 million company in 5 years? Well, no, I don't think that's ever going to happen. Well, then maybe the valuation is out of whack. So from an angel perspective, put a 5x and 5 on it to see if you think that's really a reasonable assessment on it. Does anybody else have any ways you test valuations?
One of the things we notice about valuations is that where you're shopping the deal matters. And so the price that you can get funded in Boise is different than what you can do in Seattle, is different than what you can do in Portland, and significantly different than what you can do in the Bay Area.
Right. Yeah. When we went national, we started seeing the regional differences from around the country. We're in the Midwest, Texas, and I can always tell when I get a Bay Area deal, they have 100K, but they're worth $20 million. How do you get to that? Well, I'm in the Bay Area. Oh, that's right. You got more money than you know what to do with. So you do see regional differences. And the thing to consider about that is if you can raise all your money in that region, that's great. But realize more and more fundraisers go national. You have to reach out outside your region. And if you price yourself out of the markets, you may find it hard to raise money elsewhere, and you may need those other people down the way. So you want to think hard about, your scope of where you're going to raise money, not only on this round, but the next round as well. Cool. Let's talk about participation rights. So these are things that you want to start looking at when you sign an equity term sheet. Typically, safe notes and convertible notes and KISS notes, they don't usually get to this level of detail, but in equity term sheets, they do start to get into this. And that's one reason when somebody comes to me and they want to do an equity term sheets, you must use a lawyer. I know there's documents on the website, and we'll show you where they are in a moment, but you really should have an attorney look at equity term sheets because many more of these terms are at play. And so you want to get that right. And so participation rights define the investor's right to invest in future rounds. So if I put in money and I've got a 10% stake, I want to keep my 10% stake, then I need to have participation rights to be able to put in follow-on funding with everyone else in order to maintain my pro rata share or my participation. And so most startup investors invest a small amount at seed level, and then as they go to Series A, they can invest more. And as you invest in deals, you want to think about that as well. If this turns out to be very good, have I set aside money to follow on and keep my pro rata in that good deal? That won't be all of them, but there'll be a handful that you'll want to, and you want to make sure you earmark money for those things so you can maintain your position with the company as it goes up. And I find people trying to really get a good spot in the Series A is where the decision, really comes to home on it. So what questions do we have about this?
So when we're investing at the pre-seed, I basically have the rule that I waive for newbie investors, that your goal is to get into at least 20 deals, and you probably don't want to blow more than 10% of your net worth on this crazy thing called angel investing. So $1 million net worth, divide by 10%, 100,000 divide by 20, that's $5,000 a check, right? And if I'm a 2 millionaire instead of a 1 millionaire, then it's probably better at the pre-seed level to write 40 checks than it is for you to write $20,000, $10,000 checks. And so you need to figure out what stage you're doing work at. So participation rights are a win if you're going to plan to come in at the Series A and write those checks, if you have the cash to do that, right? But how do you manage participation rights when you don't have the cash to do that? You're just barely building your 20 portfolio at $5,000 top.
So how would you do that, John?
I don't think you do. I think you have to go. But the interesting piece would be where you have the ability to manage and sell those participation rights to somebody else. That can be useful, right?
So if you can negotiate those rights, they're worth something either to yourself or to other people. So it's something to look for in these term sheets that we go through as well. And then the next one are what are called, you'll see these in term sheets, and drag along rights and protective provisions. Drag along rights give the investor the right to force shareholders to sell the startup or move, take the next round of funding. And they're very common in venture capital deals. And that's because the big money they're bringing in, they want to make sure it's not stopped by anybody else. And so you'll see those coming in when decisions are being made. As you move up the chain, to later stage rounds of funding, the later stage investors will be driving a lot of the decisions, and you'll have less decision-making capability. You're in the pre-seed and seed is where you have the most control, and then after that you lose control and you're along for the ride in some ways. And they'll put these provisions in there to actually set it up so that they can continue to carry the business through to an exit at some point, and realize they're looking for a very large exit. So you may be in there a while they're trying to get the revenue as large as possible and have the biggest payout that they can get with it. And you can see some of the protective provisions over here about selling and liquidating the company, changing capitalization structure, issuing stock, other things like that they'll be putting in there as well. And these are just very standard terms, and just realize you don't have as much control as you did before. It changes over time in that case. Anybody have any experiences with drag along rights or protective provisions?
We've ended up having some of our deals get restructured by the VCs. I'm not sure it was really drag along rights, but basically they bought out a bunch of our investors so that they could simplify the cap table, and there wasn't a lot of room to argue with them one way or the other. It was, here's the deal or forget it kind of thing.
There is an imbalance of power when you get to later stage funding. You know, you have to have their money in order to grow this to an exit. And some of them wield that in such a way to reduce your position. And that seems to be a part of the game here as well. They just want you out. And so sometimes it's an opportunity for a 3X and 3. If you think you're going to be diluted out too much, if you have a 3X and 3, you could get out that way. But it is part of the game that goes along here. Another key term is pro rata, and it's the right given to investors to maintain their ownership level in the company. We talked about that a little while ago. Pro rata is just a nice term to say keep your position or your share of the company as you go forward into it. And we got some links there that you can use to look up more of these terms going forward. Any questions about that? I think we covered that already. Another term you'll see a lot of is board and information rights. And I bring this up because sometimes they put in a board and you think there's people watching this deal. I can tell you my experience with many startup boards for seed companies is the board is really not going to take care of it in some ways. You need to make sure you stay in touch with the startup and make sure that things are going over. Some boards do well, but many boards are just rubber stamping what the CEO does, and they're not really holding them accountable. They're not really holding them on compensation, and you can see things go out of whack with boards that run companies as well. The other thing you want to look at is information rights. Information rights basically say you get access to certain financial statements and so forth. A lot of people look at that in the term sheet and they think, oh, I'm going to get these documents every month, and then sometimes they don't show up. Sometimes you don't get the detail that you want. When you invest, you need to have a discussion with the CEO about information rights. What are we going to do? Are we going to put this together every month, every quarter? Are we going to email this out? Are we going to have a conference call? And you want to get more clarity about what that is and negotiate something that is reasonable on your part, to reasonable for the CEO to put together, but at the same time gives you meaningful information as well. It doesn't always happen automatically, and so you want to keep a good rapport with the CEO and negotiate that, if we need information every month, we work out a plan for how to get that coming to the investors on a regular basis. So this can be something that entrepreneurs are up and down about. They're good one month, they're bad the next month, and so forth. And if you want certain detail, you need to get clarity on what that detail is before you go into it. Anybody have any experience with board or information rights they want to share?
Yeah, so the notion of no surprises is a win here, and it's good to have the regular cadence of people saying things, and then it's more important in some sense to hear both the bad news and the good news early. We had one of our Seattle Angel Conference companies where they were doing the smiley face, everything's happy reports. And then, they ignored actually giving us adequate detail in their information. And so when things were going weird, nobody knew about it until they were already to the point of not being able to do anything and the company blew up. So they essentially destroyed the company by not communicating where they were having some friction points. And had they communicated those, maybe 4 to 6 months earlier, there were people in the investment who could have done something about it. But by the time they got to the point where they said, oh my God, we have to lay everyone off, then nobody's going to come in and save their bacon.
Right. Good point. Cool. So we talked a moment ago about valuation. If the valuation is too high, and we see a lot of those these days, you can put in what's called a liquidation preference. And basically it pays back the investor first, then the remaining funds are allocated to the other investors based on their ownership percentage. it's very common to see 1x, 2x, sometimes 3x liquidation preferences where you're basically saying, well, given the valuation is very high, I'm going to take the first. If I put in 100K, I'm going to get the first 100K for myself of any exit, and then the rest goes to everybody pro rata, or the 2x or 3x comes out for the investor or the group of investors. And you can see these on there, trying to counteract that. One of the challenges you get into is, as an angel investor, if you get too much of that going on, 3x, 4x liquidation, it can be hard for the startup to raise funding later from a venture capitalist. There's just too much going out for other investors. And so this makes it more difficult to continue to grow the business. So you have to balance that a little bit with, what you think the right valuation is with what we think we can do to continue to grow the business. Anybody having experiences or they want to share about liquidation preferences? Go to the next one, redemption rights. This is one of my favorites. I looked up redemption rights, and historically it's not used very often in term sheets. If you see it, it previously was used at year 5 to give you your money back. And I thought, I can be in a deal for 5 years and all I do is get my money back, no return. And so I thought, well, maybe we should be doing more. But it basically gives the investors the right to sell their shares back to the company if they want to exit before an acquisition. And we're seeing more and more of that because investors are looking for the ability to move in and out of startup shares, just like they do the public shares. And so you'll see more and more redemption rights being used to give investors that out. And then you're seeing more and more companies selling or letting their employees sell their stock on secondary markets because they're staying private so much longer. The employees need to get some liquidity and you want to keep the employees happy. So they're letting the employees sell some of their stock on secondary markets. So you'll see a lot of that happening now. There's many, many companies that are facilitating secondary exchanges right now. Anybody have any questions or thoughts about redemption rights?
I think that the revenue redemption model gives us some pathways, and we haven't really had any experience with equity redemption through an equity deal in Seattle that I've noticed. But we do have a company called Manhattan Partners that is trying to broker employee stock across a bunch of places. So I think they are doing good work at the larger tech companies level, but I don't see them being effective or operating down at the early pre-seed and seed stage in a way that's useful, right? There's not any particular volume there for them to do anything with.
Can you speak to how they price these shares when they're secondary markets?
Well, and that's really the magic, is getting the right valuation on it. So there's many firms that will come in and do a valuation structure based on comps that we talked about, previous round of funding, how much the progress the company has made, and then trying to come up with a fair market value. The reality around most secondaries is that they're done with companies that are within three years of an exit. We're thinking about exiting, but the market's not right now, but in 3 years, we probably will be out. Well, that's where you'll see most of the secondaries come in.
But are these operating like independent markets where it's the market sets the price, like what people are willing to pay? So the company doesn't really have, the company's really not involved in setting the price at all.
Well, the company's really not involved in that particular case. It really is the one who runs the platform, and there's a dozen platforms out there that are doing this. Tends to be very boutique-ish. This platform caters to consumer companies, that caters to B2B SaaS companies, and they get experience with valuing what those businesses should be worth and attracting investors that want to come into those shares. So you see a lot of that. But if a company's there for 8 years, well, then at year 5 is as soon as you can ever really start to think about secondaries. So we really don't see that in seed or pre-seed or seed companies, or even Series A. It's usually a little bit much later that you get into that as well. And most of them are above $10 million of revenue. They're not usually below that in this case. And I think there's just a challenge. There's just too many startups out there to go invest in, to go and try to buy shares from a secondary where you're not quite sure and so forth. But I think we're going to see more and more liquidity come up. And the challenge is you have to have all your documents very, very cleanly set up to do the transfers and so forth. Most companies do that before they go public or they sell the business. But if you're having secondaries, you're doing similar work with audits and really understanding what's in the business, because you've got a transaction coming up as well. Another term you'll see in these term sheets is unvesting founders' shares. And I find many first-time investors or investors in startups are really, puzzled by this. Why would you unvest a founder's share when you put your money in? And the reason for that is that when a set of founders raise money for growing the business, they're usually signing up for a 3 to 4 year commitment, because I raise this money and I'm going to get the business to this place, and it's going to take 3 years to get us there. And if you don't invest the founder's shares, they keep their shares. A founder could walk out the door the very next day after they raise money, and there goes 25% of the company. And there's no shares left to pay the replacement who comes in, who will actually do the work. So what you'll see some investors do is they come in and say, we'll give you $1 million, but half your founder stock you're going to have to earn back again, 1 year cliff, 4 year window. And then if you leave early, well, you get some of your stock, but the remaining was here to pay the replacement that comes in and finishes the work that you didn't do in this case. And so it just provides equity to compensate the founder's replacement in the event they leave early. And it's often, I've seen many a company come to me where, year 2, they've already lost 50% of their shares because the employees left. They weren't vesting those shares. So you always want to have shares vesting over a period of time. And at some level that compensates them for the work that they did. And if they don't do it, you find somebody else. Any questions about that?
Related to that, this is also the point at which your due diligence should uncover your founders agreements and your employees agreements, where you have some mechanism for buying back those shares and having some kind of exit pathway for people who are getting out of the startup early. And so that should be part of the due diligence as you go along, is to make sure that when crazy founder number 3 decides to go away, they don't walk away with some significant component of the company's equity. Cool.
We already talked about pre-money valuation. It's what the business is worth before the investment. And it can also appear as price per share in some term sheets as well. I find in the early stage, the pre-money and post-money valuation are much more commonly used. And so it's you get familiar with it after a while. Any questions about pre-money valuations? We talked quite a bit about valuations before, but any other issues there with it?
Oh, can I go back to the pro rata rights? How strong is that, given that if we're angel investing and the business develops into VCs and whatnot? You were mentioning dilution events and everything. I mean, does a pro rata right help the angel investor at that point?
So to be concrete about it, SAC 16, Minda arranged for pro rata rights on her agreements with both of those companies. They just had their Series A. They just opened an opportunity for the participants in the SAC 16 to then invest more in the company and take those pro rata rights. And so we in SAC have benefited from that set of clauses when they've been negotiated.
Yeah, it's a real term you can put into term sheets, and as an investor, you should look at that to see if you want to keep your pro rata. You have the option to do so. You don't want to lose that. You don't want to give that up, and it's not given in every term sheet. You want to make sure that that's in there.
Are you finding that a lot of startups are savvy to not want that in there from a founder standpoint?
I find a lot of startups are naive about that. They don't know if you want that or not, and it's not their concern, and so they may or may not put that in there. And like I say, these are negotiations, and this is a negotiation point. You'd want to put that in there, and I think if you ask, they would do that in most cases. So I don't think that's a challenge. I think it's just a check mark thing that we need to do, make sure we're doing, so we keep our place in line with the growth of the company. And there are some people that won't take it, but if you want it, you need to make sure you have it.
And given that, if that's the case, does that make the company less investable as they reach VCs?
I don't think so. I think it's, they're looking for more funding. You do find that some startups have given away too much equity by the time they get to the Series A. When you get to the Series A, VCs want at least 20%, or the lead wants 20%. If they can't get that because you've raised too much money from convertible notes and other things, that can be hard for them to take it in. I don't think it's so much a pro rata issue as they just raised too much equity before they got to a Series A where the VCs come in. So it's not so much a VC issue. It's just the fact that they took too long to get to scale there.
Question on the percentage of shares that are invested over time. So have you ever encountered startups that are moving slower than their vesting cycle, and the startup, I guess it would be founders or main people on the cap table who have gone through their first round of vesting and the company really hasn't hit it big yet? Do companies do anything like a second time around to retain key people on the cap table?
Well, typically when you've put money in and you've given a certain vesting schedule, it's just very hard to change that. At the end of that cycle, they're going to have those shares, and now you're usually raising another round of funding. So if things are not going as fast as you would like, what you often see is that startups have to raise their next round sooner rather than later. And you'll see people coming in and they thought they'd have 3 years, but really they only had 2 years. Now they have to raise money because they didn't hit the revenue projection or what have you. And so it's always a good idea to ask, why are we raising money? Is it, of course, it's to grow the business, but one question to ask is, okay, show me your last raise and your last forecast. How did that go? Oh, you raised $1 million and this was your forecast. And then you compare that forecast with what they actually did. You start to get a sense of what the execution track record is of the company. And should they really be raising more at this point, or do we have to raise more because we just didn't hit the mark? So I think with the vesting of the shares, that's a fixed time frame. But what changes getting to the goal is usually not the individual employee; it's the overall company. I don't think it's any individual's work; it's everybody. How we all work together. And what you'll find is that, they rarely meet the goal. Sometimes they have to raise money sooner because of COVID, or they have to raise other things happen in there too, that they go ahead and they get those shares. But if they want to continue working at the company, we have to raise another round and to keep the whole thing going. So you see that issue quite a bit. Okay.
Great, thanks.
Okay. So those are basically the key terms. Were there any other terms that you guys wanted to talk about that you've seen in term sheets? Maybe we can put it out here in the last few minutes that we have to see what it is. I did put up a couple of other links up there. If you want an e-guide on negotiations and valuations, we have one on our site. Like I say, these terms are really not formulas, they're negotiations, and there's different ways of calculating it. There's about a dozen different formulas you can use to calculate valuation. And what you'll find most startups do is they go through all 12 to figure out which gives them the best number, and they put that on the table. The investor in due diligence does the same thing for their side, and they put that calculation on the table, and then they declare there's the right one. And then now we have to come together on it. So you see people looking at multiple techniques for valuing it to see how they compare against the others. if you want to see all 125 terms, there's a National Venture Capital Association site, nvca.org. It's got a set of model legal documents, the safe notes and the equity, and many of those are up there on that website, so you can check that out. And that's a great resource to look at for definition of terms as well. And there's many other sites for that also. And then our site is at 10capital.group. But any other terms or questions you guys have at this point?
So I think one of the places I'd like to spend a little bit of time is in a convertible note. There's a couple of, definitional terms that probably worth going through. So when I do a convertible note, I have this cap on the note, but people think of that as an evaluation. And so can you address what it means to have a cap on a note versus what it means to value the company?
So the cap is going to help you calculate what your valuation is going to be based on a follow-on funding round. So it's not exactly the valuation, although many advise you to do that. It's really going to help you calculate what that valuation is going to be if there was a qualified funding round. If it's a, the note just matured and there was no qualified funding afterwards, well, then it just goes as that valuation. But the idea is that when you go to raise funding for your startup and you use a convertible note, you're not setting the valuation at this point. And so what we're trying to do is come up with a method for figuring out what that valuation will be later in that case.
So we expect the cap to represent the valuation of the company at the next round of funding as a sort of maximum valuation that we're willing to accept, and we'll take a lower valuation in some sense, right?
We come in below that. That's right. It can't be anywhere above that. And that's one of the things I've found. Many investors will not sign a convertible note or a safe note without a valuation cap. When safe notes first came out, it was a little bit confusing because they come in many flavors. Some have interest rates, some don't, some have discount rates, some don't, some have valuation caps that don't. In talking to investors, the one thing they care about is there a valuation cap on it? Don't care about interest rate, don't care about discount rate. I just care about the valuation cap. There needs to be on it, because if there's no valuation cap on it, and the next round the investor or the startup says, well, I'm going to raise, this round was at 5 million, next round is going to be at 100 million. You could be, that 100 million could take your ownership down to a very small percentage because there was no valuation cap. There's got to be some rail guard on that to keep them from actually putting that way out of sight for whatever reason. And so it's a great way to bound what your ownership is going to be, even though it may not be exact up front.
Right. And can you talk a little bit about what you expect an interest rate or discount on a convertible note to be, and why we don't really care what they are?
Right. With interest rates near zero, we see a lot of convertible notes coming in with 4 or 5% interest rates. And then they have what's called a discount rate, which usually is 10 to 15%. That means you get 10 to 15% more equity when you convert to equity because you came in early. Therefore, you should get a little bit of a kicker for that. And if you sit down and do the math on it, 4% on your note, it just comes out to be, a dinner and a movie. I mean, it's really very, very small amount of money at the end of the day, and discount rates are not much better. But if you look at the valuation, this is what swings it by orders of magnitude. So when I show a convertible note to somebody or to an investor, they don't care what the interest rate discount rate. It really doesn't have meaningful numbers on it. But the valuation cap does. And that's one reason why they came up with a safe note, was they were trying to simplify it down. Let's get rid of the interest rate. Let's get rid of the discount rate, because they just don't make any difference to anybody. And it's another thing to figure out. But when startups come to us, we can easily tell them, well, the ranges are like this, and this is what we see out there today. And people plug the number in, and nobody really argues it for the most part. So that's how those numbers work.
Any other questions or thoughts from folks? Yeah, Julie.
This is slightly off topic, but if I'm making a small sack size investment in a company, but I'm also kind of rolling up my sleeves and advising them and helping a lot and become a semi-official advisor, how do I negotiate my, like a little bit of equity on top of my investment? Would that be a document, a separate document?
Yeah, you get what's called an advisor agreement. There's many on the website, and you define what your contribution is going to be, how much time, how much expertise, what you're doing, get pretty specific with it. And then based on that and based on the stage of the company, you'll get some shares for doing that. It just depends. In the early stage, you could get 1% of equity for doing a year of work. And as you get to Series A and B, that drops to 0.5% or to 0.25%, something like that. And then if you're actually spending 5 days a week, 5 days a month on it, you can actually maybe argue for more. But it really goes back to what exactly you're taking on a job just like anybody else in the business. What exactly is that job? And then you can negotiate some shares for that. And that's a good way to stay in touch with the business. You're actually taking an active role. You keep in touch with the operations, you see what's going on, you see how your investment's going forward. And so it's a great way to give back too. I wouldn't necessarily make it all free, but I don't know if you really get rich off advisory as well.
Thanks.
Sure.
So there's a Founders Institute advisor agreement that is an interesting place to start with that conversation. Many examples out there. I see Deborah asking a question. Deborah, you want to ask it directly? You're on mute.
Mute. There we go. Yeah, can you raise if you did a friends and family round with equity, can you do a convertible note for an angel round?
Yes. In fact, you'll see convertible notes used all the way through the life cycle of the company. And the reason for that is when you go out to raise funding, you're looking for a lead investor, and they may not be the first one in the door to work with you. And so you start with a convertible note and you pick up interest. So maybe the pre-seed was an equity round, but now I'm raising my seed. So I'm going to start with a convertible note. And there's a lot of investors that say, well, I just want to be in the deal. Here's 25K, and you build up some amount of money there. And then my role is I'm looking for the investor that's going to put in 100K and wants equity. Well, they're going to do a quality job with that. Or maybe I need them to do, bring some domain expertise, but I haven't come across that person yet. And I've seen startups, turn away money saying, well, no, you're not my lead investor. No, you're not my lead investor. 6 months later, they have no money and they're still looking for that magic person. And I find if they had instead taken that money and they have 300, 400, 500K after 6 months, a potential lead investor comes in and says, oh, you already have 400K. Great. That's money I don't have to raise. I think I'm going to join this, versus 6 months you've been raising, you haven't picked up any money. There's something wrong here. So I think it's a good idea to pick up convertible note money. And you'll see that at the C, the Series A, and even the Series B, as you kick that off as a bridge round or a precursor to a fundraise. And what you're really doing is you're starting to interview lead investors to see who wants to come in. But I always caution, don't a 25K check writer really shouldn't be your lead investor. They should be putting in a substantial amount of money so they do a quality job on it, because follow-on investors are going to look at that job and say, well, did they do a proper diligence on this? Did they get the right valuation? And if they did a good job on it, that it really helps bring more investors into the deal, because the lead investor knows he needs other investors to come in. So he's going to have to make that a meaningful, negotiation for other investors to come in. It's not one-sided just for himself. It's for other investors to participate as well. So you often see convertible notes kicking it off and waiting for somebody to go and convert that to an equity round.
Another great answer. Thank you.
Right. Well, at the seed level, you also see people raising convertible notes, and after 500K, they finish the note and we're done. I mean, we have our money, we don't need more, but we never converted to equity. The thing I caution startups about convertible notes is that some of them treat them like credit cards. if I need more money, I just pull out a note, write 500K on it, and start raising money. And if I raise 200K and I have what I need, I can just put it in the drawer, go work on the business. 6 months later, oh, I need more money, go pull it out of the drawer and go raise more on it. And like I said before, if you get to the Series A and the lead investor can't get their 20% because you've raised too much convertible note money, use the credit card too much, it can be a problem. But if you're using it judiciously, it's a very great tool to raise money on, because there's no escrows on it. It's a rolling close. They write the check, you write the note, it goes into the business the next day. It's very easy to use from that point of view. But like I say, too much of a good thing can be a problem later. Cool.
Can you spend a little bit of time talking about they raise a note, then they raise another note, then they raise another note, and they've gone 4 years and now they've got a stack of 5 notes?
It can get very complicated when you stack up that many notes, because now you have to start converting them into shares on the cap table because they're maturing. They have to go on there, and it just gets to be very complicated structure as well. And so one note, you have a sequence issue there for how you convert the notes over as well. And so you need a cap table tool to go figure out who owns how much. And you may be in for some disappointed investors if you did that as a startup, because investors don't own as much as they thought they did, because there's dilution coming from all different sides on that as well. So that is one issue, is if you raise too much on a convertible note and stack them up like that, investors aren't getting what they think they're getting in some cases.
Right, absolutely. Other questions?
Can you talk a little bit about 10 Capital and how you guys work?
Sure. So this company started in 2009 under the name Texas Entrepreneurs Network. I had started 3 angel networks in Austin back then, and just really enjoyed doing the angel work. And so I wanted to take angel investing to the rest of Texas. And with Texas Entrepreneurs Network, we did funding forums around the state. I estimated that for every 10,000 people in a city, there was 1 angel investor. And so I was able to get out to all the second tier cities with funding forums and make it more of an open thing. And then, driving around the state, I discovered that Texas is a big state, and you don't want to drive around it too many times because it's too much. And so I moved it all online, and we had a Texas interstate license for about 3 years, and we did a whole bunch of breweries and wineries with that license to raise money. And then in 2017, I started getting calls from other cities saying, well, I've talked to all the investors in my city. I want access to your investor pool. And so we renamed the business to 10 Capital. So at heart, we're a connector. We run investor relations and introductions for startups to go raise money. We have syndications with many angel groups, New Mexico, Rockies. We have 200 angel groups in our network, but we're active with about 30 of them. They come out to our events on a regular basis. And when companies come to us, we're helping them find more investors is what we do. We put them through email and through events, Clubhouse, Zoom, panels. We're connecting them and coaching them through the process as well. And we're working to put in some special purpose vehicle tools so we can do more of that online. More and more, I think you have to be online to actually raise funding, and we're trying to keep up with that as well. But I've always been a big believer of online fundraising, because when I ran those angel networks in Austin, I sat in the room and said to myself, well, half of what we're doing could be done online. Why are we down here? Oh, that's right. There's a wine bar over there. That's why we're down here. So, I think the dinner club model is now turning more into the online hybrid model, and we're helping with a lot of fundraisers for angel groups. We help angel groups find members. We help VC funds find limited partners. We help startups find their investor. So we're all about connecting investors in with these different groups. And we use a retainer model. We're not a broker. I found out early on that most VC funds and angel groups didn't allow brokers to be in the deal. So we didn't go down the broker path as well. So on our site, you can see what we do for investors and for startups. We have a podcast program called Investor Connect. Go to investorconnect.org. You'll find 500 podcasts up there, interviews with VCs, angels, family offices, and that's meant to foster angel education so you can learn about how to invest in startups and what other investors are doing as well.
Great, thanks.
Other thoughts?
Oh, hold on, this is almost done, maybe.
That doesn't sound like the other thought. All right. So I want to thank Paul for participating in this. He does a clubhouse call every Thursday, and so if you haven't been on Clubhouse, you might want to check that out. We're going to do a workshop on revenue-based financing, revenue-based investing from the folks at Loon Creek. They have set up a new fund, the Sage Fund in Boise, and that'll happen on Thursday. And now that you're here, you got here because of the Seattle Angel meetup group, and so all of our workshops are showing up there. Any last questions before we call it the night? Okay. Anything you want to ask us, since we have several repeat SAC investors here?
John, I have a question about accredited investors.
Yeah.
If I raise money in friends and family, and I kind of had like pucker factor when you're talking about, oh, oops, accredited investors, you know, what those people look like to downrange are going to be different. But I was wise to raise money from people of great means and great wealth. Will it be possible to get them accredited easily, such that that's not a problem? Since I think I raised from people that were accredited, though they're not officially accredited.
Well, so officially accredited means by the federal law that created the SEC, which is Reg D 501, is that they have a net worth of $1 million, not counting their house, or they have 200K in income last year, this year, and probably next year, or they have an income with their spouse of 300K last year, this year, and probably next year, or they're an organization that has a net worth of $5 million. So if you raise from people of net worth, then in your documents, you say, I am accredited because, check the box, and now they are accredited. And that's sum total of it. And if you have a lawyer that has anything going for them, they already did that for you and you didn't know it.
Okay, so net worth of $1 million, not including their house, is a good rule, is one of the rules. Okay, great.
It is one of the rules. That turns out to be across the United States approximately 10% of the population. And so in Seattle, it should be a little bit higher, but not a lot. If you're aiming for 45 to 65-year-olds that are professionals that have been in a professional role for the last decade and blah, blah, the chances are closer to 20%. But, you know, away you go. There's no test you take, although the new SEC rules are suggesting that there ought to be a test that you could take. And so that might actually end up happening, some sense of you being accredited because you're smart and you know the rules rather than you have the wealth. But right now, the best bet is just to assume on the basis of wealth. What's surprising is the number of startups that go for an equity round do not know what exemption they're using and do not know what accredited means and stand out on street corners and say, we're raising money to random people, which messes things up.
So is this a self-reporting status then?
It is.
So John, I've known a lot of the terms, but in one of your groups, you have been bringing up this exemption thing, which I have never heard of. So is this an appropriate place to talk about that?
Sure. When you do an offering, the company is the thing that chooses the offering, and they're going to sell something, right? You're going to raise money because you're selling a promissory note, which is also a regulated activity, or you're going to sell some equity or, something. And when you do that, there's limitations on who you can sell it to. So you have to sell it to somebody, you have to be registered and to sell it on a public stock market, except, and then there's about 12 different exceptions to that. And you got to pick one. Is it a Reg D 506B or a Reg D 506C or a Reg 504 or a Rule 147 or a Rule 701? There's a pile of them, right? So for most companies that get a Series seed investment, they do not get their Series A. 66% of seed funded companies do not go on to get their Series A. So as a founder, you should have a plan B for your Series A. If you're planning to get a Series A, what's your plan B for raising money if you can't activate any of the venture capitalists? Well, maybe that's a Reg CF for $5 million, or maybe that's a Reg A plus for $50 million, right? There's other pathways you can go, and you should think that out. Most startup founders have never thought as far as I just talked and don't know anything other than there's venture capitalists and I will talk to them and they will give me money, and can't tell you the difference between an angel and a venture capitalist. So angels are investing their own money. They will write checks based on how well what you're saying makes sense to them or not, and they're idiosyncratic, more idiosyncratic than venture capitalists. But you as the founder are the one that are setting the terms. And so if you go to a group of angel investors, the lead investor is the one you sort of start bouncing these things off against to see whether there's a resonance about whether they're ready to write a check. If I write deal terms for my offering that are crazy and then you get no investors, you can't sell it, right? So are there investors that are willing to do an 8% loan and be done with it and just do a loan? It turns out for some companies there are. So there was a company called Green Canopy Homes in Seattle. They did an equity loan or did an equity play for just regular investment in their company. And then they also did a loan package against the houses that they were working on at 12%. And they raised almost twice as much money on the loans for the houses than they did on the equity into the company. And so different investors have different pots of money with different kinds of constraints, with different risk profiles. And the offering that you make matters to which money pot you have access to. Anything you want to add to that, Hall?
No, that's a good point. You talk about the accredited investor status. Those rules were set in 1968, and they only changed them once in all those years. And during the Bernie Madoff scandal, they said you couldn't count your house as part of your net worth. But all those other rules were set, for many, many years ago. So you think today, how many people were accredited then versus today? There's many, many more investors available to invest based on the fact that they just never changed the rules and inflation just moved the numbers up on us. So there's this is kind of interesting to see that, there's more investors out there. I will say that accredited investors are 5% of the population is something. Last time I looked was something of that, and so we're seeing a rise now with the
10% according to the Don't Quit Your Day Job website.
10%, yeah. Well, that's gone up since I looked at it last time. Last time I looked at it was at 5, but now they have the Title III crowdfunding and Reg A where anybody can invest, and so everybody has an opportunity to be a part of that as well. So you see more and more of this coming up. And, we see a lot of campaigns coming where the Title III is running and at the same time they're raising money from angels and investors as well. So you'll see a lot of mixing coming up here pretty soon. We'll see where it goes.
So I think the default action for Wefunder is to run a Reg CF. And then when the Reg CF starts getting full and they need to move somebody out of the pile, they take all the accredited investors and create a Reg D 506C and run two parallel things. And there's nothing wrong with doing parallel things so long as you have fundamentally different structures to the deal. You're selling two different kinds of things, right? And they have a mechanism for doing that.
It's cool, yeah. Yeah, we see a lot of working in parallel together with Reg D offerings.
Yep. So if you need some sleeping material, go read Reg D 506 whatever, and it's worth going over the little nits, and then it's worth trying to have a conversation with your lawyer about one of the nits, and you'll discover where they pay attention and where they don't pay attention. So anyway, thank you so very much, Hall. This was exceptional. Really love it. You have another one that we've got scheduled for later on. You want to plug that one?
Yes, we're going to be doing another one here in about a week. I think we have that coming up, where we're going to come back and do another presentation. Let's see. Yeah, we have this on June 24th at noon your time. It's how do key metrics change over the startup stages. So if you ever want to use metrics to evaluate startups, realize they change from seed to Series A to Series B, and we'll talk about metrics and which ones to look for and how they're calculated and what's appropriate at each stage of the business.
Thank you so much. This is going to be a great conversation. All right. Bye-bye, everyone.
Bye-bye.
See you on Thursday.
Thank you all.
Thanks, guys. Have a good one. Bye-bye.
Thanks, John.
Having fun, Elaine?
Yeah, hey, I just want to make sure if Wes is hanging out, if he
I'm
needs
here.
anything. Hey, Wes.
Hey, Elaine.
John didn't know that I was going to be in the